In today's video, we're focusing on one of the big tech seven, Amazon. Despite being the biggest loser among the tech giants on Wednesday with a drop of over 2%, that doesn't mean Amazon is the weakest among the big seven. In fact, all seven are leaders in their own fields. There's no clear hierarchy, but fierce competition does exist. These tech giants are rivals, and the rivalry is intense. This isn't casual competition, it's aggressive and strategic. Take AI, for example, each of them is aiming to dominate the field. Everyone wants a lead. They want to surpass the competitors and stay in control of the future of AI to stay ahead and maintain an edge. And with the rapid growth of cloud and AI, while it's fueling huge demand for data centers, data centers need electricity, servers, storage systems, network gear, and cooling. So for tech giants, directly linking data centers to power plants can save years of development time compared to relying on a congested grid. It's such faster that way, so Amazon is investing heavily. According to reports, Amazon announced the plans to invest $20 billion in two new data center campuses in the state of Pennsylvania. This is a major investment for Amazon. If completed, it would give Amazon a strong boost going forward. The impact on its long-term AI and cloud strategy would be huge. It's a bold and strategic move, and if it plays out well, Amazon would gain momentum. This could be a real advantage in the tech race, a real game changer. Back in early 2024, Amazon had already committed to building data centers in Mississippi, Indiana, Ohio, and North Carolina. It planned to invest around $10 billion to expand its infrastructure, competing with other tech giants and meeting growing AI demand. As one of the world's biggest e-commerce firms, Amazon has doubled down on AI. It's made major AI moves and is no weaker than its rivals. In recent years, Amazon has been all in on AI. It's not just improving shopping experiences, but also innovating in voice assistants, cloud computing, logistics, and more. Recently, Amazon announced three new AI features to speed up package deliveries. So clearly, it keeps improving and optimizing. And in AI, it's investing heavily, putting serious money and efforts in, all to deliver better user experiences. So looking ahead, Amazon will remain a major tech player. Its vision is long term, and if you look at its stock, you can feel that. It shows promise and steady confidence. Yeah, Amazon is serious, is fully committed and pushing forward fast, all to enhance the user experience. So when it comes to the future, Amazon's place in tech is absolutely secure. It's thinking long term and has a solid growth strategy. You can see that reflected in the stock. You can feel the strength. Actually, Amazon, even though its rally hasn't been that strong and it hasn't quite returned to previous highs or set new ones, in the short term, that may not happen just yet. But looking at its stock trend, we can still see clear potential. The opportunity is obvious because its fundamentals are solid. It's part of the Magnificent Seven after all, and on top of that, Amazon is investing heavily in future trends, especially in artificial intelligence, where it aims to lead to dominate this space. It wants an advantage, it wants a lead, so the market has high expectations for it, and we can see that in the stock price. From a price trend perspective, especially in this recent move, Amazon remains in a long-term uptrend. This bull run isn't over yet. Especially recently, it's managed to break above the yearly moving average, a strong technical signal. Looking at the moving average right here, you will notice it's starting to shift from flat to an upward slope. It's gradually turning upward from a flat trend. The moving average system is clearly showing a bullish divergence. What this tells us is simple. In the current market, Amazon is in a bullish trend, and this trend is likely to continue. Even though earlier it went through a sizable correction, that pullback is now over. We've clearly seen a reversal take shape. That previous downtrend at this point has come to an end. So now going forward, the downtrend has been reversed. Why am I so sure? Let me show you. You will see it very clearly. At this level, we see a clear pattern, a textbook reversal setup, a double bottom. After forming the W bottom, it gapped up sharply, breaking out on strong momentum. That gap pushes through the neckline resistance. This breakout confirms an uptrend. A bullish trend has now taken shape. Right here, the breakout triggered the move. It already started the reversal, and more importantly, it retested the neckline after the breakout. That successful retest confirms the breakout, and it resumed higher, so this rally is now fully confirmed. The uptrend is intact. Once an uptrend begins, it often continues with momentum, and that momentum could extend this rally. Looking at the chart now, there's no sign yet of a top. No topping signal has appeared so far, although we saw a pullback after the breakout that was due to hitting resistance, mainly because of overhead supply at this resistance zone. It's a key level we shouldn't ignore. This area saw heavy volume, so hitting resistance here led to a pullback. A second push may still follow. It's normal to pause before recharging. Encountering resistance calls for a breather, let it reset and consolidate. Once it regains strength, then resume the push. That would be the smart move and a healthy one. This type of action makes the market more confident, more stable. It reflects a steady trend. If it fosters a breakout without preparation, it would likely fail. A failed breakout gains nothing. So this technical pullback, this shallow dip is healthy. After such a strong rebound, some profit taking is expected. Especially at this level, a minor pullback is normal. A stable retest here makes the trend more reliable, more steady. So at this level, a pullback from resistance doesn't mean the rally is over. Looking at the price action, whether long term or short term, we see no signs of a top. Nothing suggests a reversal yet. No speaks has formed, and more importantly, no trend reversal. So this uptrend is still going strong. The bulls are still in control. This rally hasn't ended yet. Besides, it's still far from its previous high, which means it's not ready to top out now. This move just started. The reversal has only just begun. So what did we just show? The W button has only just reversed. It just broke the neckline that prior strong resistance turned into strong support, then it pulled back for retest. And this retest is interesting because it's landed exactly on its 200-day moving average. Now, this 200-day line acts as key support for Amazon. It's been a major support in past moves. If you look at the earlier trend, you will see this area constantly held as support. After that drop earlier, it rebounded off the 200-day line, found solid support, then moved higher, and resumed the rally. So this time, breaking above the 200-day caused the moving average to flatten out, then begin turning slightly upward again. This confirms the trend reversal. It's a clear shift toward bullish momentum, especially at this point after breaking the neckline and the 200-day average. It then pulled back, and that pullback landed exactly between the neckline and the 200-day average. It touched the 200-day average precisely, and after finding support there, it bounced back up immediately. At this point on the chart, a very interesting candlestick pattern has formed. It's a classic bottom formation. Let me explain. These three consecutive candles form a textbook bottom reversal pattern. So what does that mean? It signals the end of a short-term pullback and marks a bullish reversal. This kind of bottom structure looks even clearer on smaller time frames. It's a strong core bottom, especially this one is a powerful bottom formation. So what defines a strong bottom? Among the three candles, if the last one, the one on the right, closes above the high of the first candle, the far left candle's top, and it finishes right at the day's high, that's a very strong reversal signal. We call this a strong bottom pattern. Now, if the last candle doesn't break the first high and instead tops out somewhere in the middle of that first candle, then what does it mean? It's only a consolidation pattern, and such a pattern may lead to another short-term pullback in price. But in this case, we formed a strong bottom pattern, plus support from the 200-day moving average and neckline support as well. So the setup is very strong bullish signal, a high conviction signal, which means the path upward is now open. So although it dropped on Wednesday, it doesn't mean this uptrend is over. The upward move hasn't ended yet because here there's no clear sign of a top, no topping signal yet. It's just a pause due to resistance from previous highs. It's taking a breather, preparing for a breakout. What it needs now, the only missing piece is volume support. But so far, we haven't seen a meaningful volume increase. Ideally, volume should rise moderately. It doesn't need a huge spike. Excessive volume isn't good. A big spike here could actually worry the market because after such a rally, a sudden surge in volume may raise red flags. That kind of volume often hints at a possible distribution. It could suggest a smart money is selling into strength. That creates doubt about whether the rally can really continue. Investors may hesitate, which leads to selling. Selling pressure builds up and the volume spikes. That's why volume should rise during the rally, but not spike sharply. We want healthy value, not excessive. Just a moderate increase is enough. That's good enough. It just needs to be higher than the last bar, gradually building up. That's a healthy volume pattern. It supports steady momentum, especially here as it runs into overhead resistance. It must be backed by volume. Without that, it's hard to break through, especially the previous highs. Once that resistance is broken, the next step is to test the previous peak. But this zone has heavier resistance than before. It's like a storm cloud overhead, dark and heavy. So to break through, volume must expand. It needs to absorb those who bought in earlier. That's why Amazon at this level may face heavy resistance. It's not the best entry point. So actually Wednesday's drop wasn't bad at all because there's pressure above. So some funds may choose not to buy here. They didn't want to enter at resistance. A small pullback instead creates technical support. Buyers will be more confident to step in at lower levels, so this is actually a healthier setup. Looking ahead, we can still stay bullish. The uptrend remains intact. There's still upside potential as long as it breaks through with volume. Keep an eye on volume. Once it breaks out, momentum will continue and test the highs again. Plenty of room to run. Alright, that's our brief analysis of Amazon. Just a quick review of the stock. If you have other views or any questions, feel free to leave a comment below.